The mom and pop investor is just about to get squeezed one more time. Canada's banking regulator, OSFI, just finalized more new mortgage rules that will make it completely and near impossible for the average Canadian to build rental property portfolios. But here's where the real problem actually kicks in. This isn't going to solve the housing crisis. It's going to make things worse by handing the entirety of the rental market to institutional investors. And if you can't imagine, that's generally speaking not a good thing for the average Canadian. So, Canada's banking regulator just completely changed the rules for rental property mortgages, and most people have no idea what this means for the future of housing in the country. Starting in 2026, banks have to treat rental property mortgages completely differently. Now, they're already doing that, and they've been working like that towards that for the better part of the last 8 to 10 years since 2016 rules came in, 2018 rules came in, COVID came in, and everything that's happened in the last year. But this means they cannot, quote unquote, double count your income across multiple properties anymore. Now, the concept of double counting is a kind of a little bit of a blurry line as it is, but this is massive. And this basically means that a rental property on its own, even though you receive rental income, may no longer be able to be considered an income source at all when it comes to banks and lenders. That's crazy. And this is a fundamental change to how Canadians can finance investment properties. So, on the surface, this sounds somewhat reasonable for a lot of people out there. Let's prevent people from quote unquote over leveraging, but the real effect is actually going to be devastating for small investors while clearing the field for institutional money. No, this is not going to drive house prices down. No, this is not going to help the average consumer own more real estate. This is only going to help those who have a lot of money, typically institutional people and lenders and investors, get into the marketplace. And we're already seeing this happen in the United States. Do we really want this in Canada? If you really want to look deeper, just Google BlackRock and you'll learn more about what's happening in the United States. So I'm going to show you exactly how this kills the small investor and why this could be terrible news actually for renters, believe it or not, and how we're actually accidentally creating a rental monopoly. Now, I don't know if this is intentional from our government and officials, or this is something where they're blind to what's actually going on, but it is a systematic issue. And let's talk about who's the winners and who's the losers. Now, let's break down what OSFI actually did. Because the technical language in their capital advanced requirements guidelines really show how radical the changes is, and it's like reading another language. So I'll break that down for you first and foremost. We're looking at OSFI's CAR guideline revisions for Q1 of 2026. That's coming up towards next year. Under the old system, if you made $100,000 salary and had $2,000 a monthly rental income from your first property, you could use your salary plus the $2,000, or at least a portion of it, in some cases 50%, in some cases less, sometimes more, for your second property mortgage. And that's how small investors built portfolios. We're getting rental income. We use that, helps to service the debt. We get into the marketplace. Now, OSFI's Mark Joshua made it completely crystal clear. Income that was used on the first mortgage is removed or corrected for when assessing additional properties. So if you used your $100,000 salary for property one, that income is completely off limits for property two. Are you kidding me? That's wild. That's a direct quote, just so you know. And they're also keeping what they call 50% borrower income test. If more than half of your qualifying income comes from a rental property itself, the banks have to hold more capital against that loan, which means basically they're going to charge you even higher rates than they do right now. And if you don't know, right now, if you have a rental property, that number is actually already surplused. So basically, they're completely making it, I don't want to say impossible, but nearly impossible for people to amass multiple properties. Keep this in mind. If you have a rental coming up in the next 2 years, if you have a rental coming up next year, we should talk right now. Here's how this kills the typical Canadian trying to build a small rental portfolio. And the math is freaking brutal. Let's say you're a teacher making $80,000 per year. Under the old rules, you could potentially acquire maybe 2, maybe 3 rental properties over time by combining the employment income and your previous rental properties. And this was obviously a middle-class wealth building strategy. These aren't the people that are hoarding properties and trying to flip them in condos. And no, obviously $80,000 is not getting your typical home in Toronto or those areas. Like we're talking about in areas of Alberta and Saskatchewan and smaller towns. And you can call it, for the sake of today's conversation, $150,000 salary. It doesn't really matter. The point is the point. The typical middle income class levels are around $80,000. Under OSFI's new rules, once you have used that $80,000 salary for your first rental property, it's gone forever. You cannot use that salary again, which is kind of crazy. Property 2 can only be financed using the rental income from property 1. And that's where the math breaks down completely. But here's the real killer number. Most rental properties in Canada generate maybe like $500 a month of cash flow at best after expenses. With rental yields typically at 3 to 5% of gross, you're looking at $6,000 of income to qualify for that second mortgage anyways. Good luck getting a bank to approve a $400,000 on $6,000 of income. Just doesn't work. The small investor who might have built a 3-property portfolio over 10 to 15 years, maybe a house, a second home, a place for one of their kids, a place for their second kids, that's basically going to be now impossible if these rules are enacted the way that they're explaining it, which completely eliminates the idea of generational wealth building, which is relied on by millions. And this is not a good thing. I don't care who you are and how anti-property pushing investors you are. This isn't a good thing. These aren't the people that are bringing house prices up. This is the average family in Canada. And now let's talk about who these rules don't hurt. Big surprise, the big institutional investors with hundreds of $millions of capital. That's who's going to eat up your neighborhoods, and that is who's going to own all of the properties in your neighborhood in the future based on these rules. So no, this is not helping out the average Canadian. This is helping out the institutional investor. A pension fund or REIT buying 100 properties isn't relying on an income from employment or from individuals. They're using institutional capital, portfolio lending, and completely different financing structures altogether to purchase these properties. And when you eliminate the competition from small investors, you're basically handing the market share over to the institutions on a silver platter. And again, I'll tell you this, they are not the reason, the small investor, that property values went way up. And they're not going to be the reason for the problems. This is going to fundamentally change how real estate works in Canada. And honestly, it'll make owning real estate even harder than it is today. Furthermore, probably driving up values in the end because the individual can only own 1 or 2 pieces of real estate. So they're going to put their capital into this, which means maybe individuals start deploying capital into the commercial markets or other areas. And here's what is really messed up. Institutions can achieve economies of scale that small investors just never could. They can renovate cheaper, they can manage more efficiently, and they can absorb vacancies losses better, which you could argue is good, but there aren't very many bleeding hearts when it comes to institutional lenders. Best believe every single year that rent's going up, and that rent is not going to be at a quote unquote minimum because they like you. What's the end result? More professional management, but higher rents, less local ownership in communities where nobody has any skin in the game anymore. It's not a good thing. OSFI probably thinks they're preventing another 2008 style crisis by stopping over-leveraged small investors, but they're actually making the housing crisis worse. Small investors were the ones providing the affordable rental housing to the average person. They bought older properties, did basic renovations, made it a place for someone to want to live, and rented them out in markets. We've all heard about the crappy landlord, but we've heard way more about the crappy tenant. And this isn't what's happening here. This is really making these markets nearly impossible. And when you eliminate the small investors, those properties, they either get bought by institutions who will dramatically increase the rents, or they get sold to owner-occupied people who are removing them. And that's not a bad thing, but it will reduce the rental supply, which means for the future, Mr. and Mrs. Renter, you're only renting condos. That's it, nothing else. Just a heads up on that fact. Meanwhile, new rental construction does require massive scale and capital that only typically institutions can provide or groups of people together. But institutional developers focus on high-end rentals. But institutional developers, they focus on high-end rentals with maximum profit margins, which is the result of this is basically total rental supply, less total rental supply, higher average rents across the board in most communities, and a market increasingly dominated by corporate landlords who view tenants as a portfolio optimization problem. Think about that. If you don't own right now, who are you placing the blame on? Let's be honest. This regulation creates a bunch of messed up incentives that nobody at OSFI seems to have considered, which are we surprised at this point right now, given the fact they still have a stress test the way it's set up right now, not thinking about the average person when it came to the renewal. First, It puts small investors towards riskier financing structures. If you can't use traditional mortgages, you start looking at private lending, joint ventures, and other creative financing that we can help people with, but we don't really want to when someone is well qualified. Second, it accelerates the financialization of housing, which everyone says they don't want. When only institutions can efficiently scale rental home ownership, housing becomes purely a financial asset and a chess piece on the board rather than community infrastructure, which is what the country says it wants. Third, it creates regional inequality. Small investors often bought in secondary markets in smaller cities. Institutions, they focus on major urban centers with max amounts of liquidity in the marketplace. And finally, it makes housing even more relied upon when it comes to government intervention. I think we can agree that's not a good thing. When private small investors exit the marketplace, the government have to fill the gap or accept deteriorating affordability and just live with the corporate investment that we see. So what this means for the average Canadian is straightforward. If you're currently a small rental property investor, or you need to understand that these expansion days could be over as early as January of next year. If you have an investment property, a pre-sale, something like that that's coming up in 2026, I'd get ahead of that now and reach out to our team. Let's see if we can get you approved. We can get approved 4 months beforehand with the existing rules before they change that. And you don't know when this is going to take effect, January, February, December. Focus on optimizing what you already have right now versus what's growing. Refinance your existing properties if possible. Maximize your cash flows, but don't plan on property number 3, 4, 5, or 6. If you have a rental property, and sure, there's some math behind this, but it might be a good idea to ask yourself the question, should I refinance, extend that amortization, open up that cash flow now because I won't be able to do it next year or the year after? And if you're thinking about getting into the rental property market for yourself, because let's be honest, maybe this means there's a greater opportunity for people. The window is essentially closing. After 2026, the math won't make sense for the normal person. Let's be honest. For renters, this probably means higher rents over time as the market works towards the institutional investors. And yes, it will. And for policymakers, this is a perfect example of how well-intentioned financial regulation can make housing affordability worse. This is why we do not want the government involved in making these big decisions. This is not good for anyone. OSFI's new rental rules that are proposed are going to fundamentally reshape Canadian real estate investment and mortgage lending. And not in a good way. They're solving a problem that doesn't even exist. Over-leveraged small investors weren't the cause of housing affordability. And all the while, we're creating new problems that's going to make everything worse in the next 5 to 10 years. The future of real estate housing in Canada is going to be increasingly corporate, increasingly expensive, and increasingly disconnected from the communities that they're supposed to support. This is exactly the kind of regulatory change that sounds good in a boardroom, but it just creates a massive unintended consequence in the real world. And yeah, I'm fired up by this because I've seen and will continue to see the potential positive impact of providing people with an opportunity to create wealth in an area that they should be allowed to do so. And yes, I am pro small investors doing it the right way. No, I'm not talking about those housing flips. Please understand, I'm talking about the average family that wants to create generational wealth for them and their kids by creating an opportunity in their community. And these are the good people. These are the people that are awesome landlords. These are the people that we love to work with. If you found this information impactful, subscribe to the YouTube or the podcast. Give me a thumbs up, leave me a 5-star review, and share this to somebody else out there who needs to know about how massive this is going to impact them when it comes to their rental mortgage next year. And if you're feeling fired up by this and you want to either A, look at your portfolio, B, look at your potential property coming up in the next year, go ahead and click and contact my team and I. There's a link in the bio, and we'll see what your portfolio looks like and if we should address it right now. Thanks for paying attention, guys. We'll see you on the next one.